All right, let's get right into it. The silver market has just gone absolutely vertical. But if you think this is a simple story, you're missing what's really going on beneath the surface. So today we're going to peel back the layers on what's actually driving this insane move and figure out if it really has the legs to keep running. So, get this. For the first time since March of 2026, silver just blew past $80 an ounce. Now that number, that's a big deal on its own, but it's really the speed of this move that's got everyone talking. I mean, just let that sink in for a second. We're talking about an 8% jump in just 2 weeks. 10 days ago, we were sitting at $74. For a major commodity like silver, that is a massive, massive move. And it's all happening with this giant cloud of geopolitical uncertainty just hanging over the whole market.
And that brings us to the big question, right? Is this a genuine, sustainable breakout that's being driven by some really deep market forces? Or is this just a flash in the pan, a knee-jerk reaction to news headlines that could just as easily reverse on a dime? Well, to figure that out, we have to start with the trigger.
Okay, so the very first layer of this whole story, it's all about geopolitics. The conflict between the US and Iran has just been throwing gasoline on the fire, creating this enormous volatility where the market is jumping at every single headline and every single rumor. And if you look at the timeline, it's been a total roller coaster. It's just whiplash. On February 28th, Operation Epic Fury kicks off and shuts down the Strait of Hormuz. Boom! Then, April 8th, a ceasefire is announced and silver takes off. But wait, just 4 days later, the talks completely collapse. And then, by April 15th, new rumors of talks start swirling, and that's what sends silver on this incredible surge past $80. All of this is leading up to the make-or-break ceasefire deadline on April 22nd. You see, the market is pricing in a peace deal that isn't even signed yet.
Right, but this geopolitical tension, it's not happening in a vacuum, right? It feeds directly into the second layer of our story, which is the US economy and its own stubborn inflation problem. Let's look at the data, and you'll see how this whole thing builds.
The latest numbers are pretty startling. Headline CPI for March, 3.3%, the highest we've seen since May of 2024. Producer prices are up 4%. But here's the really interesting part. The thing you have to understand, this is not some broad economy-wide inflation. Nope. This is almost entirely an energy shock driven by the war. I mean, gasoline prices alone shot up over 21% in a single month. That's a really critical distinction to make.
And because of that distinction, it creates this absolutely fascinating dilemma for the Federal Reserve. Just look at the two paths here. It's almost a heads I win, tails you lose situation for the Fed. If the war ends, great. Oil prices fall, inflation cools off, and the Fed can finally pivot and start cutting interest rates. That's bullish for silver. But what if the war drags on? Well, then high energy prices eventually crush consumer spending, the economy gets weaker, and the Fed is forced to cut rates anyway. It's this wild paradox where both roads seem to lead to a Fed pivot.
And this brings us to the deepest and honestly, maybe the most important layer of the whole silver story. Forget the headlines for a second. Forget the inflation data. There is a powerful, structural imbalance brewing right under our noses. This growing tension between actual physical metal and the paper market that's supposed to represent it. Now, before we go any further, you got to understand this one key term. COMEX registered silver. This isn't just any old silver bar. This is the specific, good-for-delivery, certified metal that's sitting in the exchange vaults. It's the stuff you can actually get your hands on to settle a futures contract. It's basically the bedrock of the physical market. And right here, this is the core of the issue. Right now, there are only about 77 million ounces of this deliverable, registered silver ready to go. But at the exact same time, there are over 571 million ounces worth of paper claims, we're talking futures contracts, all laying claim to that same pile of silver. The gap between the two is it's massive.
Let's just put a single number on it to make it clear. For every 1 ounce of actual, physical, deliverable silver sitting in the COMEX vaults, there are 7.5 paper claims stacked right on top of it. Now, usually that's not a problem because most people just settle their contracts for cash. But as we've seen, these are not normal times.
And here's the real kicker. That tiny little pool of physical metal is getting smaller. The registered inventory has been draining away almost constantly. It's down more than 60% from its peak back in 2021. So what you have is more and more paper leverage being piled onto a shrinking physical base. That is a classic recipe for stress in any market.
So with all that on the table, the geopolitical trigger, the Fed's inflation dilemma, and this physical squeeze, how are we supposed to think about all this? Well, let's just lay out the two competing arguments, the bull case versus the bear case. The bulls, they're looking at this and they see a perfect storm brewing. They're pointing to this stagflation setup, right? High inflation, weak GDP. They see a structural supply deficit that's now in its 6th year in a row. They look over to China, the world's biggest consumer, and see them ramping up their silver imports to an 8-year high. And then there's the classic signal, the gold to silver ratio is compressing, which historically means silver is getting ready to outperform gold.
But hold on, because the bears have a really powerful case too. And their argument is all about the immediate risks. That April 22nd ceasefire deadline, it's a huge binary event. If those talks fail, oil could spike again, forcing the Fed to stay aggressive and keep rates high. And from a technical standpoint, this breakout isn't even confirmed yet. A close back below $78, well, that would be a classic fake out, the kind of move that traps eager buyers all the time.
So this is a really complex story. How do you track it yourself without getting lost in the noise? Let's boil everything we've talked about down to a simple framework, the key signals that you need to be watching.
Really, it all comes down to 3 things from here on out. First, that April 22nd deadline. It is the most important date on the calendar, period. Second, watch today's jobless claims data. Is it the first sign of a crack in the labor market? And third, keep your eyes glued to that $78 price level. Can silver hold above that critical technical floor? These 3 signals will tell you more about where this market is headed next than anything else.
And that really leaves us with one final, much bigger question to think about. This isn't just about the price of silver anymore. This growing, massive disconnect between paper claims and the shrinking physical supply underneath, it makes you wonder, is what we're seeing in the silver market just a preview of a much larger stress test for the whole system? A test where the promises of paper markets are finally forced to confront a very hard physical reality.